Before we invest in any stock, we need to make sure that we're avoiding a permanent loss. So in today's session, we're going to dive deep into liquidity and solvency, the two main components of financial safety. Let's find some value. Liquidity isn't about being rich. We don't need a company to be sitting on boatloads of cash. In fact, that might be a sign that the company isn't being wise and deploying available resources to grow the business. But what we do want is for the company to have enough liquid assets that can be readily converted to cash so that it's not forced into making bad decisions. So to measure liquidity or short-term safety, we're going to look at two key portions of the balance sheet: the company's current assets and the company's current liabilities. Current assets are assets that can be readily converted into cash within 1 year. Some examples of current assets are cash, short-term investments like investments in securities, receivables, and inventory. Now on the other side, current liabilities are obligations that are due within 1 year. These include payables, accrued expenses, short-term debt, and the current portion of long-term debt. The 1-year cutoff is conventional. It's a proxy for soon enough to matter. What we're trying to assess when we look at these two parts of the balance sheet is whether a company has enough current assets that can be converted to cash within a year, to pay off the current liabilities, the obligations it will have to pay within the year. In general, the higher the current assets, the better, and the lower the current liabilities, the better. But to find the right balance between the two, we're going to calculate two ratios. The first ratio we look at is the current ratio. The current ratio is equal to a company's current assets divided by its current liabilities. And what this ratio is asking conceptually is, do we have at least $1 of short-term resources for every dollar of short-term obligations? Here's how we can think about the ratio. What we typically don't want to see is a ratio below 1, because that indicates that the company might be dependent on future cash flow or refinancing to pay its near-term obligations. What we want to see on average is a ratio above 1, which would indicate that the company has some cushion to deal with its short-term obligations. Now, whenever we do any financial statement analysis like this, we have to consider the context of the business. The ideal current ratio will depend on the company's business model and industry. For example, biotech companies often hold large amounts of cash reserves because they raise a lot of capital from investors to fund long and costly R&D projects. Because they hold a lot of cash, they also typically don't need a lot of short-term debt, and that results in them having very high current ratios. On the other hand, restaurants or businesses in the hospitality sector typically operate with lower current ratios. All of them collect cash from customers immediately at the point of sale. This means they don't have meaningful accounts receivable, which deflates their current assets, and they also don't need to hold large cash balances to fund long development cycles. At the same time, many of their short-term obligations, like payments to food suppliers, utilities, and landlords, are either funded with credit cards or some other form of short-term debt, or they're paid after the revenue has already been collected. In other words, for them, the expenses are already incurred before the cash comes in later to pay the expenses. Because of this timing, restaurants often operate with low current ratios, sometimes even below 1, without experiencing liquidity stress. So whenever we look at the current ratio, or any other ratio we'll analyze in these lessons, it's important for us to view them in the appropriate business and industry context. So keep that in mind, but to make this more practical for you, here are a couple quick, loose rules of thumb that you can apply. In general, a current ratio less than 1 can be a warning sign. This means that the business does not have enough current assets to cover its current liabilities, which in businesses that don't have the quick cash conversion qualities that restaurants have can be problematic. A good current ratio is typically within 1.5 to 2. At these levels, and for the most part regardless of the business model, the company can adequately meet its short-term obligations without needing to take desperate actions. Now lastly, very high current ratios relative to other peers in the industry are also not always a good thing and can indicate that the company may be using its liquid resources inefficiently. Now, one major drawback of the current ratio is that current assets do include items that don't always behave like cash during a crisis, especially inventory, which may not be super easy to liquidate depending on the situation. This is where the quick ratio comes in. The quick ratio is a more strict version of the current ratio. Here's the formula for the quick ratio. The quick ratio is equal to cash plus marketable securities plus receivables, all divided by current liabilities. Now, the first thing you'll notice about the quick ratio is that it does not include inventory. That's because of what we just mentioned. Inventory is not always liquid. It may need to be discounted in order to sell fast, and it can become obsolete, especially if the inventory includes perishable items. During an economic downturn, inventory is often the first thing that gets marked down. You'll also notice that the numerator of the quick ratio includes cash and other assets that can easily be converted to cash. And so what the quick ratio makes us consider is the following. If we ignore the least reliable short-term assets, can the company still meet short-term obligations? Again, the higher the quick ratio, the better. As a general rule of thumb, a quick ratio of around 1 or higher is often a sign of strong near-term liquidity. If the quick ratio is below 1, then something you will want to dig deeper into as an investor will be the company's ability to generate cash quickly or convert sales to cash. Some questions you will want to consider are, is the company's inventory genuinely easy to sell? Does the company have stable and predictable cash flow? And does it have access to credit lines which can allow it to meet its other obligations? Alright, so those are two very important ratios that we want to make sure we look at when we assess a company's safety. And ideally, we want both of them to meet our desired benchmark. Alright, now up to this point, we've looked at liquidity in terms of ratios, the quick ratio and the current ratio. Ratios are great because they help us standardize things. They help us compare companies of different sizes. But at the same time, ratios mask orders of magnitude. In other words, they don't tell us how big the actual liquidity cushion is in absolute terms. This is where working capital comes in. Working capital is simply current assets minus current liabilities. Instead of asking whether short-term assets cover short-term obligations in percentage terms, working capital helps us determine how much of a short-term buffer the business has in actual dollars. Again, the fundamental reason we care about working capital is timing. In almost all businesses, cash inflows and cash outflows do not occur at the same time. Expenses are incurred on one schedule, and cash is collected on another. Working capital is the actual dollar buffer that allows a business to function smoothly through that mismatch. Without working capital, even a profitable business can fail, simply because it can't bridge the gap between when it must pay its bills and when it receives cash. From a safety perspective, working capital is about room for error. Positive working capital tells us that a business can absorb delays in cash collection, handle unexpected expenses, and respond in time if conditions worsen. On the other hand, negative or very thin working capital tells us that a business is operating closer to the edge. Small disruptions in the market can immediately force the company into unexpected action, and in general, management will have fewer options in a downturn. So working capital doesn't tell us whether a business is good or not, but it does tell us how much breathing room a business has. Here's a quick example to show us why looking at working capital is important. Suppose there are two companies, both with the exact same current ratio, but both also with very different risk profiles. One might have $50 million of working capital, modest fixed costs, and stable demand. Another might have $2 million of working capital, high fixed costs, and volatile demand. Although the current ratio is the same, let's say 1.5, the margin for error from an operation standpoint is completely different between both these businesses. So the actual dollar amount of the buffer between current assets and current liabilities And some of the other data points as well, like cost structure and the cyclicality of the business, can provide us with a bit more color to evaluate the company's safety. Here's another useful way you can think about working capital. You can ask yourself the following questions. What happens to the business if revenue drops for 3 months in a row? Or what happens to the business if customers start paying more slowly? Or what happens to the business if a supplier suddenly demands a faster payment? Well, working capital is what will help the business get through these types of scenarios without having to issue new equity, borrow on unfavorable terms, or cut into the core business. Alright, so let's quickly recap some of the metrics we've learned to assess a company's short-term liquidity. The current ratio tells us how much of a company's short-term obligations are covered by its liquidable assets in percentage terms. In general, the higher the current ratio, the better, and a current ratio between 1.5 to 2 is ideal. The quick ratio is a stricter version of the current ratio that excludes inventory. It tells us how much of the company's most liquidable assets, which have a 100% cash conversion percentage, cover short-term obligations. On average, we can consider a quick ratio of 1 to indicate strong short-term liquidity. And finally, working capital, current assets minus current liabilities, tells us the dollar magnitude of the cushion the company has to meet its short-term obligations. In general, more working capital is better and affords the company more options and time in the event of a shock. Alright, so let's move on to long-term safety, because so far we've been concerned with the short-term, liquidity and the company's ability to meet short-term obligations. But here's the thing. Short-term liquidity alone cannot guarantee a company's survival. A company can have plenty of cash today and still be fundamentally unsafe because its capital structure is fragile or weak. This is why long-term safety is important to look at. And long-term safety is mainly concerned with solvency. In other words, the company's ability to meet obligations not just in the short term, but over longer periods of time. For example, through an entire economic cycle without destroying shareholder value. In simple terms, solvency asks the following question. Can the business support all of its obligations with its earnings power, not just in a good year and not just under normal conditions, but also during downturns, industry slowdowns, and unexpected shocks? What makes a company solvent or not essentially boils down to how optimally financed the company is. In other words, what sources of funding drive the company's ability to function well, and are those sources optimized given the particular business model that it operates? This requires us to understand the company's capital structure, in other words, the mix of debt and equity financing that the company relies on. These two sources of capital, as we explained previously, equity and debt, will behave very differently under stress. In general, we prefer equity over debt, because equity absorbs shocks and volatility, while debt does not. Debt forces us into fixed payment schedules, which are legally binding and that we can't get out of. Debt doesn't care how well our business is doing. Debt demands a payment, either our cash or the collateral that we pledged. And so in general, under most circumstances, we prefer equity to debt. Having said that, debt isn't always a bad thing, and debt is oftentimes essential, but it has to be used the right way. When it's used the right way, it becomes a powerful tool that allows companies to generate excess returns while putting fewer of their own resources into the business. That's precisely why we refer to debt as leverage, because it amplifies returns while keeping the owner's inputs constant. The problem arises when debt is mismatched with volatile earnings, cyclical demand, or assets that don't reliably produce cash. Under those circumstances, a highly leveraged capital structure becomes a lot more risky. So the key lesson is this. Debt can be both powerful and dangerous, but it depends on the circumstances. In good times, it amplifies returns by allowing companies to move faster and make bigger bets using fewer of their own inputs, but in bad times, it amplifies risk. And so the key question for us to consider is the following. Is the business's earning power sufficient and stable enough to comfortably service its fixed obligations over the long term, and especially through adversity? Companies that are solvent have capital structures that are compatible with the stability of its cash flows, flexible enough to absorb volatility, and survivable without constant refinancing. Insolvency rarely arrives suddenly. It usually develops slowly as obligations grow faster than the business's ability to support them. And that's really what we want to screen for and avoid. One of the simplest pictures of a company's capital structure is its debt-to-equity ratio. Debt to equity is equal to total debt divided by shareholders' equity. This ratio tells you how the business is financed, specifically how much comes from the lenders versus how much comes from the owners. If a company has a debt to equity ratio of 1, that means that the company is financed equally by debt and equity. And so in general, a lower debt to equity ratio is more favorable. Now, just like any of the other metrics we discussed, the ideal debt-equity ratio for a company is going to depend on its industry and business model. Capital-intensive industries like utilities, mining, and manufacturing require lots of debt to fund the purchase of assets and equipment. For these types of companies, debt-equity ratios in excess of 2 or sometimes even 3 are not that uncommon. On the other hand, for asset-light industries like software, debt-equity ratios tend to be a lot lower, sometimes even below 0.5. In other words, many software companies fund their operations with twice as much equity as debt. And so when we look at long-term safety and solvency and metrics like debt-to-equity, we can't view them in a vacuum. We have to view them relative to the company's industry peers. But so that you have something tangible to hold on to from this lesson, here's some quick rules of thumb you can get started with. A debt equity less than 1 is typically considered conservative and safe. A debt equity between 1 and 2 is often seen as a sign of a healthy and well-balanced capital structure. Finally, a debt equity in excess of 2 typically signals higher risk. Now, it's important to note that sometimes equity can be very small or even negative. That can happen if the current value of a company's assets drops below the value of its liabilities. In those types of cases, the debt-equity ratio isn't that useful to us, and we'd much prefer to rely on a metric that's tied to the company's earnings power. That's where the net debt to EBITDA ratio comes in. A company's net debt to EBITDA ratio is its net debt divided by its EBITDA. Now, what in the world does that mean? Let's break it down by the component parts. Net debt is the company's total debt or total liabilities minus cash. The reason we subtract cash is because cash can be used to pay off debt, and so net debt is a measure of the company's effective debt. In other words, it's debt that may actually be burdensome to the company. For example, if a company has $1 million of debt, but it also has $1 million in cash, then that $1 million of debt isn't a true burden because that debt could be paid off immediately. So the numerator of the ratio tells us the debt that is actually burdensome to the company. Alright, now what about the denominator? What is EBITDA? EBITDA stands for earnings before interest, depreciation, taxes, and amortization. EBITDA is a rough proxy for the company's earnings power from operations before accountants and the government gets involved. It essentially represents the raw cash profit the company makes from the core business operations, and it strips away things like taxes and interest in order to show us how much firepower the business actually generates every year to cover its obligations. EBITDA is often used as a proxy for cash flow. So for the purposes of this ratio, we use EBITDA over a 1-year period. That is, how much raw cash flow does a company generate in a single year? And so with that in mind, when we put both of these components together, what net debt to EBITDA tells us is the number of years it would take a company to pay off its debt if it only uses operating cash flow. This gives us a nice picture of how well the company's earnings power can cover its debt burden. Now again, the ideal ratio for this depends on the industry. But in general, a net debt to EBITDA ratio of 2 means that it would take the company 2 years of current profits to pay off its debt, something which most lenders would consider healthy. A net debt to EBITDA in excess of 5 would mean that it would take the company more than 5 years of profits to pay off its debt burden. Ratios in excess of 5 are often seen as a sign of high leverage. Alright, so let's move on to one last ratio that's going to help us evaluate financial companies. Financial companies like banks, insurers, and asset management firms run very different businesses compared to most other companies. For most other companies, debt is optional financing, and because of that, it's oftentimes viewed as a burden. But for banks, debt is a core driver of the business. In other words, debt is the business model. Most of the debt at a bank consists of customer deposits, and a bank needs that debt in order to make loans, which is its core product. The magnitude of a bank's debt is massive compared to the amount of cash that it holds. So if we look at a standard debt-equity ratio to evaluate a bank's safety, the bank is going to look like it's in a state of permanent distress. Similarly, EBITDA is not a great measure of a bank's earnings power. That's because EBITDA adds back interest expense. But that's not appropriate for banks because interest expense is a core operational expense for banks. Interest is how the bank makes money. It makes money by charging more interest to borrowers compared to the interest that it pays to depositors. Because of that, interest is not something we want to add back to a bank's costs in order to measure its true raw profit. So net debt to EBITDA, likewise, is not a great ratio to use to evaluate a bank's safety. That's where the financial leverage ratio comes in. The financial leverage ratio is also known as the equity multiplier, and it's the gold standard that we can use to evaluate the safety of banks and other financial institutions. Financial leverage is equal to the company's total assets divided by total equity. For a bank, its primary assets are its products, loans, mortgages, bonds, and so on. These are the assets that generate money for the institution. And so what financial leverage tells us is this. For every $1 of the owner's money, how many dollars of the loans, mortgages, and bonds does the company control? Now, this ratio is useful for evaluating the safety of financial institutions for the following reasons. First, it shows us how much a bank has stretched its own capital to buy or create its assets. The higher the ratio, the riskier the bank's business is. Second, the financial leverage ratio helps us measure the buffer a bank has in terms of the value of its assets. For example, if a bank has a leverage ratio of 10, it means they have $10 of assets for every $1 of equity. This tells an investor that if the value of the bank's loans drops by just 10%, then the entire equity is wiped out. This is the most direct way of seeing how much of a safety cushion the bank has. Finally, the financial leverage ratio aligns well with banking regulations. Global banking regulations like Basel III and IV specifically set leverage caps on banks. They don't allow banks to stretch their own equity too much. Regulators don't really care about a bank's EBITDA. They care about how many total assets a bank is holding relative to its own equity. So here are some tangible benchmarks you can use to evaluate financial institutions' leverage ratios. Leverage ratios between 10 to 16 are conservative and safe. They're considered well capitalized by regulators. Leverage ratios between 16 to 25 are moderate or typical. This is the standard operating range for many large banks. And finally, leverage ratios between 25 to 30 and above are aggressive, and they're approaching the regulatory limits. Alright, so that does it for long-term safety. Here's a quick recap of what we just learned. The debt-equity ratio tells us how debt-funded the business is. In general, the more debt is used to finance a company, then the more constrained it will be under times of stress. Net debt to EBITDA tells us how debt-heavy the company is relative to its earnings power. The lower the ratio, the better, and the more capable a company is of meeting debt obligations from only its core operations. And finally, for financial companies, our preferred safety measure is the financial leverage ratio, which tells us how much risk the financial institution is taking by stretching its own capital to fund loans, mortgages, bonds, and other core products. So that's it for this session. We've completed our safety assessment. We now have a solid framework for assessing a company's financial safety by looking at its liquidity and its solvency. And for each of these, we have a nice set of metrics that we can use to get a clear picture of a company's financial resilience. In the next video, we're going to dive deep into part 2 of our framework for evaluating businesses. We're going to study what the competitive moat is. In other words, what makes a business durable. We're really looking forward to it, and we hope to see you there.